International trade. Okay, now let's say if you want to invest in a foreign country, there are two ways you can do it. Either you can purchase the stock of an existing business. I want to invest in a banking, so you can simply purchase a banking stock. And another way is that we can just simply create a new business. This is called foreign direct investment. So when you purchase stock of an existing business, this is another type of investment, portfolio investment. Or else you can take your cash, go to a foreign country and start a business yourself. This is called foreign direct investment. Madhu, I've noted your question. I'll explain it separately in WhatsApp. Legal and compliance risk. Then we have advantages of direct foreign investment. If you decide to make direct an investment in Mexico, let's say you are in the US and you want to make an investment, direct foreign investment in Mexico to start a new bank there. This is called direct foreign investment. Or maybe you want to set up a manufacturing plant in Mexico because maybe there's cheap labor from Mexico. You can take advantage of cheap labor. So what are the advantages? The first advantage is that Mexico will welcome you by offering you less taxes, lower taxes in foreign nations. This is the first advantage to you. Second, that when you make capital investment in Mexico, this capital investment will result in some allowances which will further reduce your tax payables. This is an advantage. And the most important one is that you will gain access to foreign capital sources. You can issue shares in Mexico, you can issue bonds and preferred stock, and you can take loan from the banks also. So these are the advantages of foreign direct investment. Local resources could be utilized. Then, of course, when you go to Mexico, I'm sure most of you know Mexico is a very dangerous country. There are many issues. It's quite unlawfulness there. I'm sure you know. So not only you're facing exchange rate risk when you convert peso into dollars, this is the currency used in Mexico, into US dollars. So there's always an exchange rate risk. Conversion of pesos into dollar or dollars into pesos. So since the exchange rate is changing, so it could result in gains and losses at the same time. I hope you remember, Subhan. Depreciation is a tax allowable expense, right? Just like your rent, insurance, salary, interest. So any such expense attracts tax savings, mean you will have to pay less taxes. Any expense that is tax allowable, it is charged as a deduction from your taxable income, and it therefore results in lower tax payables. So depreciation allowances, you can say, these are the reductions in your taxes payable. You are not only getting the lower tax rates, but you're also being given tax allowances in a kind of reduction in tax payable. Depreciation tax shield, exactly. Okay, then we have sovereignty and political risk. It's a very dangerous country. So you risk losing your investment there. If there is a government change, political changeover, your money is gone. Many US firms have lost a lot of money in Mexico because the country is governed by militia. It's a very dangerous country. I'm sure most of you know what happens there. Cartels, largest drug dealers are in Mexico. They provide drugs to the US. They have a very long border, porous border. There's a lot of issue between US and Mexico. So there's sovereignty risk, political risk also, because your investment might be lost. If there is a political changeover, you lose everything. Then there's an interesting concept I would like to explain. American depository receipts. Now let me explain this idea. Let's say I am in Pakistan right now, and I want to raise money by selling my shares in the US. I can't get listing in the US, or maybe I don't want to get listing. So how can I raise money by selling shares in the US? This can be done by creating a block of shares called ADRs. And these shares are then given to a bank. And these banks can then issue share ownership rights to investor A in America, B, C, D, E. This way, I have been able to raise money from the US without getting listing. So this is called American depository receipts. Pakistani businesses can raise money in the US by depositing their shares with a US bank. This US bank will then issue ADRs to investors in the US. So their money will then be routed to you. So remember, you might not confuse with GDR. This is the word frequently used also. ADR involves investments in the US alone. When you say GDR, which is Global Depository Receipts, these are the receipts issued simultaneously by different country, country X, country Y, country Z. When you say Global Depository Receipts, so these are the share issues in different countries simultaneously. But when you say ADR, these are the shares, your shares issued to Americans through a bank. That's why it's called American Depository Receipt. So this is also a way you can invest in the foreign countries or raise money from foreign countries. Next, we have foreign investments. When you start your business in Mexico, where the money would come from? You need money. You can take some money with you from the US, but still you need local money, local funds. It's advisable. If you're running your business in Mexico, take local funding. If you're working in Nigeria, you have taken your investment in machinery, borrow locally. It is recommended that will involve local ownership, so your business will face less political risk. So how the foreign investments are funded? If I'm in Mexico, where the money would come from? The first source is the money from the parent company, the money brought from US. Second, I can issue common stock in Mexico and raise equity finance. I can issue bonds in Mexico, or maybe I can borrow from international world financial market rather than just from Mexico, from other international donors, right? Not from the local bank. So these are the sources of foreign investment. Now, when a US-based firm moves to Mexico, there are some benefits to the US. Let us discuss those benefits. US firm has now moved to Mexico. What are the benefits to home country? And remember, our home country here is the US. So what are the benefits to the US when a US-based company moves to Mexico? First, earnings are improved. Initially, there was a tariff on your products in Mexico. Now you have set up your own facility. You produce there, you sell locally, and you export from Mexico to the rest of Latin America. You make a lot of money. So you earn in Mexico, and from there you export also. So this is the advantage to the US. Then there was limited availability of labor and resources, material. Now you are in Mexico, lots of resources are there. You can obtain limited resources which were not available in the US. Third, benefits of free trade. Now there is more trade between the US and Mexico because of this international operations. It will make more product availability, better understanding of international system, all the benefits that come from international trade. So these are the benefits to the US. But there are drawbacks also. When the US companies relocate or invest in Mexico, we should expect some drawbacks, adverse effects on the home country. And when we say home country, that is US. So what are the adverse effects on the US economy? The first one, loss of jobs. When the company relocates to Mexico to reduce cost, jobs are lost. Government tax revenue is lost because this firm was paying tax in the US. Now it's paying tax in Mexico. Tax revenue is lost. Then instability caused by reduced flexibility of operations in foreign political system. Your company is now operating in Mexico. Mexico is highly volatile country, highly politically unstable, and there is a risk that your assets might be expropriated, assets might be forfeited. And then competitive advantage of multinationals over domestic rivals. Now your firm has moved from the Mexico, your local market is exposed, multinational in your country, the US, can further increase their strength and local businesses might be affected. Now let us consider the benefits to the host country. And when we say host country means Mexico, where you have set up your business. So there are some benefits to the Mexican economy. Let us discuss one by one. The first advantage to the Mexican economy is the new investment is coming. New technology is coming, which was not available. Yes, profit will be higher, but they will have to be repatriated also. Management abilities, new management expertise will come. Improvement in output and efficiency. Since new technology, new management has come, so output and efficiency will increase. This will result in increasing your balance of payment. Your economy will strengthen. And at the same time, it will also stimulate competition. Local Mexican firms will become more active. Now they have more competition, so they become more proactive. It will increase tax revenue for the Mexican government. And since now more money is generated in the economy, more people are employed in American businesses, so there is higher standard of living. So these are the advantages to host country. In our example, the host country is Mexico. Now let us discuss some adverse effects on host country, and host country here is Mexico. So what are the adverse advantages? So most likely you might see these on your essay section, or maybe in MCQs also. So you need to know what the advantage, disadvantage. So the first disadvantage is whatever is earned, Vakas, the profit, it is paid back in the form of royalties to the US. Royalties mean the parent has some technology, that technology is being used in Mexico. Mexican subsidiary must pay royalties to the US parent. Mexican business must pay dividends to the parent, and the profits must be repatriated. This results in net capital outflow. Dollars will leave Mexican economy in the form of profit repatriation. So you can make more profit, Vakas, but this profit will go back from where the money came from. Again, many multinational companies, they engage in a practice called transfer pricing, deliberately manipulating profits so that the taxes could be avoided. Tax avoidance. You try to reduce your profit in Mexican economy so that you have to pay less taxes. And this is done through transfer pricing. This is the area that has been totally moved to your CMA Part 1. So you just have to keep this idea in mind, that setting transfer prices among subsidiaries so that you pay less taxes. And this will clearly affect the Mexican economy because a rightful amount of tax is not being paid. And then since American companies are financially very strong, they take a lot of funds with them, so they can use their powerful position, resources to engage in anti-competitive activities. They might engage in, and they might use money to buy politicians. This happens. Even in Pakistan, many foreign companies spend a lot of money on lobbying. They have politicians in their pockets. So this is called engaging in anti-competitive activities, such as the formation of cartels, or maybe they can use their financial resources to influence politicians in decision making and can force them to take decision that favors these multinationals and not Mexico. These are the adverse effects. Now, some important points related to international trade. Methods of financing international trade. I sell to foreign customers in India, UAE, Saudi Arabia, US. So it is sold on credit. I don't get money immediately. So how do I finance my international trade? So how the money comes to me? So let us discuss few sources. First is the cross-border factoring. We'll discuss in detail. Letters of credit could be used to finance your international trade. Bankers' acceptance is linked to letter of credit. Forfeiting and counter trade. So let us discuss these briefly. Cross-border factoring means I sell my goods to my customers in India, in UAE, in Saudi Arabia, in USA, and all of these buy on credit. So how do I collect from them? So what I do, I enter into an arrangement called cross-border factoring. A cross-border factoring is a network of factors present in India, UAE, Saudi Arabia, and USA. So these networks of factors will collect money on my behalf. These factors will pay me. I will receive my $100 million after discount. And then these factors can collect money on my behalf, and they will, maybe if they will pay in full, I'll receive the money at discount. Or maybe they will collect the money from them and then remit me the balance amount after deducting their commission or their collection fee. So this is one of the ways where you can get your collections from your customers on an international scale. Cross-border factoring means a network of factoring businesses that will help you expedite your payment from foreign customers. Next, we have the letter of credit. I sell my goods to my customer in Kuwait, but I'm little doubtful that I may not receive money on time. So I ask my customer in Kuwait that he should open a letter of credit in my name with my bank, Arab National Bank. Now the customer has received the goods and all the documents under the LC are okay. Now my bank will collect money from Kuwaiti bank and money will come in my account. in an assured way. Letter of credit is a secured way. Still, there can be default, but it's a secured way to collect money from your international customers because of bank to bank. My bank will transact with his bank, and then when the goods are delivered, the documents under the LCs are okay, I will receive my money. So this is the second way. Third is the banker's acceptance. Now, I will explain. I have sold goods to a Kuwaiti customer, and under the letter of credit, he will pay me after 3 months. Right? This is the time. He will pay me after 3 months. I need money now. I need money now. Under the letter of credit, banker has accepted my document and he has stamped it accepted for payment. It could be a draft drawn on my company's letterhead. It could be a bill of exchange, whatever the title specifically required in LC. Those of you who have worked in LC would know that the document prepared under the LC, there is one instrument that will assist you in receiving your payment. It is drawn on your company's letterhead with the title draft or bill of exchange or note as required by the terms of letter of credit. Now, once this draft or bill of exchange has been accepted by the bank, marked accepted, it becomes very valuable. It's called banker's acceptance. Now, if I need money, this draft will mature in 3 months. I need money now. This bill is for $10 million. I can get it discounted from some finance company, and that company will give me maybe $9.5 million. So at least I receive money quickly and I can use it for my business operations. I have to give up my $0.5 million. Just this is called the discounting of bill of exchange or discounting the letter under the LC. So this is another way to collect money on international scale. Then forfeiting. Forfeiting is a form of factoring that don't confuse cross-border factoring and forfeiting. Both are factoring basically. Both are factoring. This is factoring also cross-border, and forfeiting is also factoring. The difference between these is that cross-border factoring involves a network of factoring businesses that collect money on your behalf, or maybe they pay you in advance after deducting their fee. Forfeiting is factoring, but this is for medium to long-term customers internationally, right? Forfeiting could be maybe 1 month or 2 months. They could be up to 2 years or maybe up to 5 years. So both are factoring. The difference is that on international context, this is short-term, and factoring your receivables in medium to long-term, this is called forfeiting. Both are factoring. This is the fine difference that you need to keep in mind. And finally, the last one is the counter trade. Counter trade simply means goods for goods. Like what we do with India, we sell them tomatoes and they sell us onions, right? So this is goods for goods. So you don't need cash, neither they nor you. So counter trade or barter is another way of conducting your international trade. And finally, last thing, treaties. Now, let's say you are in Mexico, you are originally from the US, you pay tax in Mexico at the rate of 30%. Whatever remains, what you call the profits after paying the tax, is now repatriated to the US. Again, this should not be considered as an income for the US parent because tax has already been paid in Mexico. If US and Mexico has a treaty under which only tax will be paid only once, so that means any company in Mexico that pays in tax in Mexico, it doesn't have to pay tax in the US. Or any Mexican company that pays tax in the US at the rate of 40%, it doesn't have to pay tax in the Mexico. So there is no double taxation. Either you pay tax in Mexico or in US, not both positions simultaneously. And then the transfer pricing, I told you that companies might engage in unethical activities where they might over-invoice or under-invoice. They might charge for royalties or management fee just in order to avoid taxes. They try to show less profit where the tax rates are high, and they try to show a proper profit where the tax rates are low. So this way, by transfer pricing, the companies try to manipulate profits, so as the overall international global tax payment could be lowered. All right, so guys, that is over. Now let's do a few questions to grasp the idea better. All of the following are valid reasons for expansion of international businesses by the US multinational corporations, except. Now, we have been given the 4 reasons for expansion. We have been given the 4 reasons for expansion. Which of these is a valid reason that the US business should go to Mexico? So you need to read these options. Which of these is not a valid reason Out of these four, there will be three valid reasons and one will not be. So let us first see which is valid, which is not. Secure new sources of raw material. This is a very valid reason why we do that. Find additional areas where their products can be successfully marketed. This is a valid reason why we go to Mexico. Minimize their cost of production. This is a valid reason why we go to Mexico. Absolutely, Omar, you got it right. Protect their domestic market from competition from foreign manufacturers. Then you should stay in US. You should not leave US. So this is not a valid reason. This is a wrong option, and that is why our right answer. Because we need to find the one that is not a good reason for diversification. Next. Which of the following statements concerning American depository receipts is false? Let's move in the reverse order. ADRs are securities issued by American banks acting as custodians of shares of foreign firms. And these banks then issues ADRs to local Americans. Correct. ADRs allow foreigners to raise capital in the US. Correct. ADRs allow Americans to invest abroad. So Americans can invest in MCB's ADR while they are still in the US. This is correct also. ADR facilitate the banking procedures for the US multinational firms. Wrong. ADR is a way through which foreign companies can raise money in the US. Next. A British company, it's a good question, gentlemen. A British company currently has domestic operations only. It only operates locally. It plans to invest equal amounts of money on projects either in the US or in China. Equal amounts, 50% in the US, 50% in China. Right now, you are a British company. So you want to invest equal amounts in the US and China. The company will select the country based on risk and return for its portfolio of domestic operations and international projects taken together. Now, the risk reduction benefits of investing internationally based on 50% of British domestic operations and 50% foreign operations will be greatest when there is, I hope you will remember, when two investments are perfectly positively correlated. X goes up, Y goes up, there is no benefit of diversification. Benefit is maximized when two investments are negatively correlated. Negative correlation means when you combine these investments, like X is generating returns this way, right? And Y is generating returns this way. When you combine these two sine waves, which are in opposite direction, this crest is offset by this trough is offset by this crest. So in a way, you get a nice, stable return lines. This is how diversification works. Two businesses whose returns are in opposite direction, combining such firms will reduce volatility. We don't like volatility, right? So that means positive correlation is rejected. We need those with negative correlation. So it's either B or D. Let us see. Negative correlation between the US and Chinese returns. Okay, most of you are saying D. Negative correlation between Chinese returns and British returns. If you read the requirement, it says the company will select the country based on risk and return for its portfolio of domestic and international projects. Domestic and international. And remember, you are a British company. So either it's going to be British Chinese or British US, not US and Chinese. That is what makes B to be incorrect. And that's why all of you selected D. D is the right answer. Negative correlation between Chinese and British return. This is it. British and Chinese. So that makes D to be the correct option. Correct. All right, next. Technocrat Incorporated, located in Belgium, currently manufactures products at its domestic plant and exports them to the US. Belgian goods sold to the US. For Belgian firms, it's exports. For the US, it's imports. Since it is less expensive to produce at home. What is it? Again, you lost track. I lost track. Technocrat Incorporated, located in Belgium, currently manufactures products at its domestic plant in Belgium and exports them to the US since it is less expensive to produce at home. Okay, Belgian production is cheaper. They produce in Belgium and sell the goods to the US. The company is considering the possibility of setting up a plant in the US. All of the following factors would encourage. Let us highlight exactly what are we looking for. All of the following factors would encourage the companies to consider direct foreign investment in the US except? So out of these four, three are the valid reason why we want to go to the US and not one of them, which is not a right reason. We have to select the one. Expectations of more stringent trade restrictions by the US. If this is so, we should not move. We are looking for the one that is a welcome to us. All of the following factors would encourage the company to consider the direct foreign investment in the US except. Expectations of more stringent trade restrictions by the US. If the US puts more restrictions on imports, then it is better that I should go to the US and start producing goods there. This is a valid reason why I should move to the US, because US is putting more restriction, more trade restrictions, more import taxes. So I should set up in the US. This is the valid reason why you would go. Depreciation of the US dollars against Belgian currency, which means when you take your Belgian currency there, you will be able to convert lots of Belgian currencies into lots of US dollars. So this is the valid reason why you should go there, right? Widening the gap in production cost between the United States and Belgium. Remember, you're already producing goods at a cheaper cost, maybe $10 here and $50 there. If this gap widens, not good for me. If this gap widens, my difference of production cost will be more. This is not something that is good for me. In this case, I should not. This is not a valid reason. Let us see D also. Changing demand for the company's exports to the US due to exchange rate fluctuation. Since there is an exchange rate volatility, so things can move because of exchange rate volatility. So it's better that I should set up my business of production units in the US. So I produce locally and sell locally. So I will be having less exposure to foreign exchange, at least in sale. Yes, there will be an exposure when you would like to convert those dollars into your currency, but at least on the sale side, the exposure could be reduced if there is a local production. So please make sure you get it fully. If the gap of production cost is more, this is the production cost locally, this is the production cost in the US. If this gap widens and it costs me more to produce in the US, then I will not be willing to go to the US. So this is the not a right reason to move. Rather, this is the discouragement. This is not good. C is not the right reason to go there. Hence our right. So production costs in the home country are already lower than the US. If this gap widens, then clearly going to the US will not be suitable for us. Next. All of the following are concerns that are unique to a foreign investment, except, mind the word, concerns that are unique to foreign investment, except exchange rate risk. This is a valid concern. It's a valid concern. Purchasing power parity, we'll discuss this in our, inshallah, coming lectures, but only to the extent that is required. So this is again a concern because the money once transfer from one place to another, the purchasing power is affected when you convert one currency to another. We'll discuss it in detail. This risk is also expropriation, the risk of assets being taken over by the government. So A is the valid reason. You should concern about A. You should be concerned about A. You should be concerned about B. You should be concerned about D. Changes in interest rate that are there everywhere. Changes in interest rate. We face same interest rate volatility in Pakistan, similar interest rate volatility in X country, Y country. So this is something that is not unique to any country. This is everywhere. A, B, D are the reasons in international context, concerns in international context. But C is something that is prevalent in every country. This is not unique for international operations. So hence, this is something, not a valid reason, not a concern, because this concern is not suitable for international context. It is everywhere. Yes, because interest rate will change, but this is something not unique to international business. Interest rate risk is unique to every country, right? If you are here, you face interest rate risk here. If you are there, you face interest rate there. Risk is everywhere, right? What are unique to international context are exchange rates when currencies are converted, purchasing power risk. This is again international context factor. Expropriation risk that your assets are taken over by hostile foreign government. So A, B, D are unique risks on international context in foreign trade. Interest rate is typically it's the same for everyone. Every country has it. It's not unique. It is not unique to international trade, right? Interest rates are an aspect of doing business within any modern economy. They are not unique to foreign investment. I think the explanation says it all. Next. For an American investor who wants to avoid legal restrictions on investing in equity securities of Pakistani companies, the most frequent means of making direct investment through the purchase of American depository receipts that we have just discussed. And if the shares are issued to many different countries through depository, that's called global depository receipts. Okay. From the seller's perspective, you are the seller. The least risky form of payment in international trade. Least risky form of payment. Open account means selling on credit. There can be default. Letter of credit, even it is brought into action through banks on buyer and seller sides both, but still there can be a problem if the documents are not accepted under the LC. Your payment will be blocked. Prepayment, you collect money in advance. Trade acceptance, again, it will involve letter of credit, right? So this is prepayment. You receive money from your customers first. This is like cash on delivery, or maybe it's like when you pay your supplier first, only supplier will deliver you the goods, right? Prepayment. Get the money from them first, then deliver the goods. This is the safest. The rest of them have some risks. An exporter delivers goods to a retailer for sale to the public. An exporter delivers goods to a retailer so that retailer can sell the goods to the public. If the exporter is paid off after sale to third parties, this arrangement is called what? It's basically you have sold goods on consignment. Your retailer will sell the goods, receive money, make his cut or his commission, and remit the balance to me. So this is called consignment. I am the consignor who sells goods to him. Yes, Umar, absolutely right. And the person who receives is consigning. So this is consignee, not trade acceptance. That is basically under the letter of credit, not credit sales, and it is again not barter sale as well. The method of financing international trade that necessarily involves sales of medium to long-term receivables, this is called forfeiting, right? Medium to long-term. And if it's a network of factors in different countries, that is what you call the cross-border factoring. This is it. A cross-border factoring involves using a network of factors in other countries who will collect money on your behalf and facilitate and speed up your payment. Okay, here we go. X company is an American company that wants to sell widgets to D company, a Danish company. American company is the seller. Danish company is the buyer. X company is unsure about D company's ability to pay on international scale. What it should do? Not transact business with D company. That is not good. On international scale, you have to buy and sell. So this is not a good response. Transact business with D because American laws require D to pay. American laws are only applicable in the US unless it's a money laundering law or RICO law. There are many laws that have international application, just like some provisions of Foreign Corrupt Practices Act. They are also applicable on international context. Sarbanes-Oxley Act, some provision of Sarbanes-Oxley Act are also applicable on international context. So, but not every law is applicable on international scale. This is wrong also. Transact business with the D company because Danish law requires to pay. Is this the reason why I should sell? Out of these, prepayment would have been the right option. Yes, Umar, you're right, Vikas. Or the letter of credit. Out of these, D is more secure. At least two banks are involved, the banker from the buyer side and the seller side. So between bank to bank, the payment is more or less assured in a way if the goods are delivered and documents are accepted under the LC. So that makes D to be the correct option, and that ends our international trade.